What if I told you you only need 3 funds to build serious long-term wealth? No stock picking, no guessing, no constantly checking charts, just 3 simple ETFs. This approach has been used for decades by long-term investors, including what's known as Bogleheads index investors. And today, I'm going to show you exactly what they are and why they work. In the last episode, we talked about what an ETF actually is. Now we're taking the next step. How do you actually invest in ETFs in a smart, proven way? This strategy is called the 3-fund portfolio. It's used by long-term investors, financial advisors, even retirement fund managers. Why? Because it's simple, low cost, and diversified across the entire world. And most importantly, it has a decades-long track record as a simple and highly effective way to invest. The idea is simple. Instead of trying to beat the market, you become the market. You own the entire US stock market, the entire global market, and a stabilizing layer of bonds. So no matter which company wins, you're already invested. First fund, the total US stock market ETF. This includes Apple, Microsoft, Tesla, and thousands of other companies. Instead of betting on one company, you own all of them. Example, ETFs are Vanguard Total Stock Market ETF, Schwab US Broad Market ETF, or similar broad market funds. Historically, the US stock market has returned roughly 9 to 10% annually over the long term, based on S&P 500 data across many decades. Not every year, but over decades, that's the average trend. Second fund, International Stock Market ETF. This gives you exposure outside the US, Europe, Japan, China, and emerging markets. Why does this matter? Because the US doesn't always outperform. There have been entire decades where international markets outperformed US stocks. This fund protects you from relying on a single country's economy. Example ETFs, Vanguard Total International Stock ETF, VXUS. iShares Core MSCI Emerging Markets ETF, IEMG. Now you're not just investing in one economy, you're investing in the entire world. Third fund, bonds. This is where most beginners get confused. Bonds are not for growth. They are for stability. When the stock market crashes, bonds tend to drop less or sometimes even increase in value. This helps reduce volatility, although bonds can still decline in certain market conditions. Example ETFs, Vanguard Total Bond Market ETF, iShares Core US Aggregate Bond ETF. Historically, portfolios with bonds grow slower, but they help you stay invested during downturns, which is often more important than short-term returns. So how do you split your money? A common starting point might look like 60% US stocks, 20% international stocks with 20% bonds. But it ultimately depends on factors like your age, risk tolerance, and goals. If you're younger and focused on growth, 70 to 80% stocks with 20 to 30% bonds. There's no perfect formula, but the principle stays the same. Diversification plus consistency equals long-term growth. Let's be real. Most people lose money because they panic sell during crashes, chase hype, try to time the market. This strategy avoids all of that. You're not guessing, you're simply investing regularly, holding long-term, and letting the market do its job. 3 funds. That's it. Simple, but powerful. In the next episode, I'll show you how much you should actually be investing and why you don't need a lot of money to start. So you're not just learning, you're actually building wealth. If this made investing feel simpler, you're exactly who this channel is for. See you in the next one.